Now, does it really matter if you have a lower interest rate or not? Well, yes, it can make a big difference when it comes to doing the math. If you actually do the math, you're going to see exactly how much it costs you in the long run. A lot of people see the short run, which is 1 to 3 months, but if you look at it for a few more years, you're going to see it all adds up. For example, let's compare 6% interest rate with a 7% interest rate on a $200,000 loan amount. So if we do the math, we're going to see that if we calculate what the interest is going to be on $200,000 on a 6% interest rate, we're going to be able to see that on a 30-year mortgage, the total payment is going to be $1,199 with 10 cents, of which $1,000 is going to go just to interest. And principal will only have, or the amount that's going to go towards principal is only going to be $199 with 10 cents. Now you can see why there's such a big difference and why it makes such a big difference to have a lower interest rate. Now, if you had a 7% interest rate, you'd be paying $163.93 towards principal, and you're going to be paying $1,166.67. So if you subtract the interest that you're paying on a 7% interest rate and on a 6% interest rate, you would subtract $1,166.67 with $1,000 minus $1,000, and you're going to see that you paid $166.67 extra by having that 1% extra or higher interest rate. Now, it might not mean a lot for some people, but if you factor it over the long run or over the life of the loan, you're going to be able to see that the total interest that you paid in excess by having that 1% higher interest rate is $47,341.42. That's just 1%. Now, if the interest rate difference is higher, if it was between a 6 and an 8%, you can obviously calculate that, and you're going to see that the payment is even higher. Also, when the loan amount is higher, you're going to pay more in interest. So you have to take that into account. Now, this is money you're just giving away to the bank or the lender simply because you didn't prepare beforehand. So you need to make sure that you either have a higher down payment or you have better credit scores, so that makes a big difference. Also, what this course is all about, you need to use the 10 tips, which I'm going to teach you in this course. They really make a huge difference, okay? If you really want to reduce your interest paid over the life of the loan, I suggest you get a 15-year mortgage if you can afford the monthly payments, because it's really going to reduce the amount of interest you pay over the life of the loan. And the interest rate is always lower, which is something a lot of people don't know. I have a 15-year mortgage right now, and the increase in payments I overcame by having what's called a bi-weekly payment, which simply means whatever your payment is on a monthly basis, you divide that by 2, which would be, so if you're making a $2,000 mortgage payment, you divide that by 2. So every 2 weeks, you're going to pay $1,000. Or actually, every other Friday is what banks actually do, even though they call it bi-weekly, but it's every other Friday. So at the end of the year, you made an extra mortgage payment, and that lowers the amount of interest you paid over the life of the loan. And that's how I have my mortgage set up. I just wanted to mention that, but it does make a big difference, and it helps out in the end.